Lululemon stock has been smashed, from over $511 a share down to about $189 today. That's a collapse of more than 63% for one of the most premium brands in retail. Think about it. A company once priced like a market darling is now trading like it's in trouble. This is the same Lululemon that turned $128 leggings into a global fashion status symbol. So, is this the once-in-a-decade moment to buy, or the start of a bigger slide? Today, I'll break down exactly what's happened, the strengths and cracks in the business, the numbers that matter for long-term investors, and my personal trading plan, including entry, stop loss, and take profit levels. More videos will be made on this topic in the future. Make sure to subscribe so you do not miss them. Snapshot. Lululemon was founded in 1998 in Vancouver, Canada, and is now one of the world's most recognized premium athletic apparel brands. Ticker LULU, trading on the NASDAQ. After this sell-off, its market cap has dropped to $32 billion from highs over $50 billion. The brand runs about 700 stores worldwide, plus a strong e-commerce platform. Unlike Nike or Adidas, Lululemon sells 100% direct to consumer, no wholesalers, which means tighter control over pricing, brand image, and margins. Why the price dropped? So why the huge drop? US sales growth has stalled. North America, still their biggest market, is hitting saturation. Tariffs from China and Vietnam are squeezing margins. Same-store sales missed expectations, and management cut forward guidance. Competition is heating up. Alo Yoga, Vuori, and even Costco are selling cheaper, near-identical alternatives. All of this has made Wall Street question whether Lululemon can keep its premium edge, strengths, and moat. But here's what hasn't changed. Loyal customer base, willing to pay for quality, fit, and brand status. Gross margins at approximately 57%, far above the 40% industry norm. ROIC over 30%, showing exceptional capital efficiency. Community-driven marketing, yoga classes, ambassador programs, and grassroots partnerships keep customers engaged beyond just the product. This isn't a fad brand. It's a status brand with deep roots in its community. Rule number 1, long-term numbers. If we run Lululemon through the rule number 1 checklist, the 4 M's, meaning moat, management, and margin of safety, the long-term numbers hit the quality benchmarks across the board. Meaning, sales have grown at roughly 18% a year over the past decade. Rule number 1 likes to see consistent, double-digit growth. Lululemon clears that bar easily. Moat. Earnings per share have compounded at approximately 23% annually, showing pricing power and brand strength. Free cash flow has grown even faster at 26%, which means customers aren't just buying the product. They're funding a highly profitable model. Management. Return on invested capital is approximately 30%, double the 15% rule number 1 benchmark, meaning leadership is deploying resources extremely effectively. On top of that, the company carries no long-term debt, giving management maximum flexibility. Margin of safety. The current PE is approximately 13, less than half its 10-year average of 30. The PEG ratio is approximately 0.7. Under 1 can indicate the market is undervaluing future growth. Using a conservative growth rate of 15% in my intrinsic value calculation, lower than their historical 20% plus, I get a fair value around $438 a share. At today's approximately $189, that's a 57% margin of safety, comfortably above the 50% rule number 1 threshold. If you think Lululemon still deserves a premium multiple, type 1 in the comments. If you think its best days are behind it, type 0. Bull case. Macro tailwind. The Fed is expected to cut rates in the next year. Lower borrowing costs often boost premium discretionary spending. And in past cycles, brands like Lululemon have seen sales bounce sharply. Rate cuts also tend to lift growth stock valuations. Valuation and levels. At the current price of $189, Lululemon trades at roughly 15 times earnings, about half its historical average. This suggests that a lot of bad news may already be priced in. From a technical perspective, there's strong support around $176 and resistance near $230. Trading between these levels could offer shorter-term opportunities, while a break above $230 might signal the start of a larger upward trend. Balanced view. That said, this isn't without risk. If U.S. demand continues to weaken, tariffs increase, or competitors successfully pull away Lululemon's core customers, the share price could fall further. International expansion is promising, but at under 20% of total revenue, it's not yet large enough to offset domestic weakness entirely. So that's my Lululemon company portrait. A premium brand now trading at a beaten-down price, with the potential for a macro tailwind from falling interest rates. I'm entering in the $180 to $190 range, protecting my downside with a stop loss, and targeting $230 to $260 for profits. What's your move? Would you buy here, wait for even more downside, or stay on the sidelines? Drop your thoughts in the comments. Be industrious, brothers. Are you ready to join us on this journey? Are you ready to win? If you're enjoying this content, show some love, hit the like button, and give it a thumbs up.